Right. Okay. So learning unit 5, let's just slideshow. Yeah, let's do that. Okay. Okay, that doesn't help you really. Ah, there we go. So learning unit 5 is partnerships. Partnerships, okay? What we've been doing so far from 1A all until now has been pretty much sole proprietor or sole trader type accounting, okay? Now with partnerships, everything is the same, it's the same, it's the same, it's the same. The only difference is now your equity accounts. That's the only real difference, okay? That's the only real difference, okay? Here it says the main difference when compared with the sole proprietorship is the structuring of proprietary accounts and subsequently the equity section in the statement of financial position. In addition to these additional equity accounts, partnerships also require a custom-made year-end procedure that usually involves an additional account called the appropriation account. Okay, the appropriation account is another temporary account, right, which we use to split up profits or to also distribute rewards and punish, so to speak, what's this? People who have ownership or partners in the business. All right. Accounting records of a partnership. The only yeah. Okay. So we spoke about this, right? Then here they begin to talk about the actual equity accounts of a partnership. So you have the capital account. Okay. Right. Now the capital account is usually where we would do the things that we are then going to do in the actual appropriation account. Okay. In a partnership, the capital account is only for capital contributions, period. Okay. Even drawings at year end is going to go through the appropriation account. Okay. Unlike the capital account of a sole trader, net profit or loss will be credited or debited to the capital accounts at year end, but rather to the current accounts. All right. Drawings will also be closed off against the capital account at year end. Will also not be closed off against the capital account at year end, but against the current account. Okay. The current account is for the respective partners, and you'll see how these things practically work when we link up on Thursday. It is thus quite clear that we would like to reserve the capital accounts for capital contributions only, nothing else, literally, just capital contributions. The reason for doing this is so that certain perks can be allocated based on the capital contributions of the individual partners. Okay. So I made a bit of a mistake there. I said the appropriation account is the account we use to reward and punish. It's actually the current account. Okay. I meant to say the current account is what we use to reward and punish your partners, so to speak. The current account, the appropriation account is what we use to distribute profits. Okay, and you'll see this when we get there. Okay. Here they're saying the current account, the purpose of the current account is to allocate certain perks and penalties to the partners. Okay, I basically was talking to that just now. I just said punish, but it's the same thing as penalize. Okay, interest on capital and positive current account balances, salaries and bonuses. Those are the perks. Penalties, interest on drawings, negative current account balances. That's when we would be typically penalizing you. The current account also facilitate the distribution of profits and the closing off of individual drawings accounts at year end. So basically, when we have established how much profit is going to which partner through the appropriation account, it then goes to the current account of that respective partner. Does that make sense? All right, so we're still figuring out what we are distributing in the appropriation account, all right, to the partners in terms of profits, but then it is distributed to the current account. We together there? Because remember, we're rewarding you by giving you your share of the profit. we're rewarding you. Does that make sense? Okay. All right. And remember here, what are we doing? Just to recap quickly, because now I'm throwing all these different accounts to you that you never heard before. We said when we started with the slide, the only difference between a partnership and the accounting that you've been seeing all along, all right, which is the sole trader, is that we have these equity accounts. And that's what we are now delving into and speaking on. Does that make sense? So your current account, appropriation account, all those are equity accounts. Now we also have a salaries and bonus account. But this is not your typical salaries and wages that you guys have seen. This is particularly pertaining to partners in the business. So again, this is also equity accounts. And we use this to say, okay, let's say I'm the sales exec, all right, and I obviously have a stake in this business, right? And if I meet certain sales targets, we've agreed that I'm going to get either a salary, an additional salary, or a bonus as a result of meeting targets. Does that make sense? So we're not looking at this like typical salaries and wages, okay? Obviously, then that'll get paid to that account. Does that make sense? Okay, right. Let's move on. Then interest on capital, that's also another one. Once interest on capital has been accounted for, it is allocated to the partner's current account. Okay, so that's that double entry. Obviously, I had a positive amount on my capital balance. Okay, so then interest on capital is going to be affected, and then obviously the current account will also get affected. Okay. Let's move on. Interest on drawings. Now you're looking to penalize me. Okay, so interest on drawings is going to be affected, and then obviously my current account is also going to be affected. Okay, you guys can read through this in your own time. All right, interest on current accounts. Okay, the purpose of allowing for interest on current account balances is to ensure that distributed profits from previous years gets plowed back into the business. Okay, so here they're encouraging that we keep money in the business so that the business can use those funds. Instead of me withdrawing those profits and obviously charging them, they want to encourage that we pour back money into the business. And that's how are they doing that? Giving me interest on my current account. All right. If a partner were to make drawings in excess of the available equity balance shown in the current account, the account will go into negative territory, which means the partner will plow back negative equity in the business. Therefore, interest can either be positive or negative, depending on the state of the partner's respective current account balance. Okay. Right. All right. Interest received if it's credit balance, in other words, a positive balance. All right. And then if it's a debit balance, then it's going to be interest paid. I'm the one who's paying this. Now here they're talking about the appropriation account. Okay. For a sole trader, there are two final accounts, namely the trading account and the profit and loss account. In a partnership, we will encounter a third final account, that being the appropriation account. The appropriation account is the final account used to close off all the individual salaries or bonus accounts of the partners, as well as the interest on capital account, current and drawings account, thereby determining the remaining distributable profits to partners after an optional transfer to or from the replacement reserve that can be credited to the partner's current accounts. Okay, replacement reserve, that's basically if we want to retain some of the profits to fund business activities. Okay, some of you may have come across this term before, retained earnings. Okay, the partners or the owners of the business are entitled to all the profits. All the profits of the business are for their partners. That's their reward on actually engaging in business. But we can say, no. As your financial manager, I recommend that we hold back 50% of the profits. That 50% that I'm holding back is what we then are referring as to the replacement reserve or retained earnings. Does that make sense? Okay. And that 50% we can then use for whatever purposes. Okay. The most noticeable difference will be found in the equity section of the statement of financial position, as well as the statement of changes in equity. Okay, we will see this, so I don't think we need to go into it now. We will see these things. Okay, admission of a partner. Okay, so upon admission of a new partner, an admission agreement will have to be drawn up, which would regulate the following matters: capital contribution of the new partner's interest in the net assets of the partnership, the manner in which profits and losses of the partnership will be shared among the partners. Legally, a change in partnership ends the existing partnership. I'm sure you guys have gone through this in business management. Ends the partnership that was existing and creates a new one. Okay. Memorandum treatment: the assets or goodwill or both are revalued only for the purpose of the new admission, but not incorporated in the financials. Okay, goodwill, we know goodwill, if we look at the value of a business, usually it's based on assets minus the liabilities. That's the worth of the business. Okay, now goodwill is saying, look, we know that Coca-Cola is more than just its assets minus its liabilities. It has a very strong brand. All right, the moment you see Coca-Cola, you know exactly what this thing is about, right? And it also makes customers feel a certain type of way. Same thing with Nike, same thing with Apple products. There's just, it's more than just its physical assets minus its liabilities. And that's where goodwill starts to come into the picture. In other cases, you can also think of, from a technology standpoint, I'm trying to think, Microsoft. You can trust that, okay, this thing functions properly if it's a certain brand, HP, etc., okay? So it's more than just, the truth is that some computers perform just as well as others, but because it's this, you're going to pay more. That's, your goodwill, your branding, and so forth, so forth, so forth. So here, elements of goodwill: sound management, good labor, customer relations, valuable trademarks, franchises, McDonald's, for example, site advantages, effectiveness of advertising. All right. So if I was to go and buy a McDonald's franchise, it's going to cost me more than when I'm going to go and buy a fish and chips franchise. Does that make sense? Because it's McDonald's. You get what I mean? So those are the things that we're talking about when we're talking about goodwill. Okay. So I won't get into this. All right. So just like we can add in a new partner, we can also withdraw a partner. Okay. All right. And in doing so, that means we're dissolving the partnership as well. Whenever there's a new entry of a partner, whenever there's someone leaving, we're basically dissolving the partnership. Okay. And that is it. That is it. But whenever we dissolve a partnership, things that we must just be aware of: the following needs to be established from the accounting records during the dissolution of a partnership: the profits or losses realized as a result of the sale of assets or statement of debt. Okay, we can't just say, oh, so long. We have to actually say, okay, this is the profits that you're entitled to on your departure. Or if our business was making a loss, this is how much you need to pay from your side in order for us to settle this loss. Okay, the manner in which the gains and losses on the dissolution of the partnership will be distributed between partners. Okay, spoken to that. The manner in which the final disbursement must amongst the partners takes place. So the final disbursement, final payout of the profits. That's what the disbursement, what they're really talking to over there. All right. So, any thoughts, questions, concerns? Nothing. Okay, guys, that's really it for today. I will see you on Thursday online, and we will jump into a few exercises. Then I won't see you for another 2 weeks or so. No. I do see you next week, right? Or I don't. Okay. Either way, all right, at least now we are in good stead in terms of how much content we've managed to cover thus far. Right. So I think I told a lie about 1B. It's easy, ne? It's not bad, huh? No, I said if there was a time to drop out, it's now. But now I'm saying actually this is child's play, this one. Yeah? They're still enjoying.